folks, welcome to second part of this video on operating leverage. In the first part of this video, we discussed how companies like Airtel, BSC, MCX, Mahindra & Mahindra, TVS Motor, Apollo Hospital and many others created massive wealth because profits started growing much faster than revenues. And more importantly, we understood that not every operating leverage story is same. Some are structural and sustainable for many years, whereas some are purely cyclical and temporary. The key is to identify the difference between structural versus cyclical companies. The best option is to participate in companies where structural operating leverage that can create wealth. So if you want to play the cyclical operating leverage, you need to make sure that you enter during early cycle where there is enough room for margin expansion. Majority of people make the classic mistake of investing in cyclical business at peak of margin and end up destroying wealth. So if you haven't watched the first part yet, I would strongly recommend watching that first because this video is basically an extension of that framework. In this part, we'll go one level deeper and try to identify companies where operating leverage can potentially continue in FY27. Because ultimately, the biggest wealth gets created not after operating leverage becomes obvious to everyone, but when investors identify the possibility of margin expansion early. Now, one very important thing to understand here is past operating leverage looks great in hindsight. Anyone can look at historical chart and say, wow, margins expanded from 10% to 25%. But the real question investors should ask is, can margin continue to expand from here? And even more importantly, how sustainable is that margin expansion? Because markets are always forward-looking. Just because a company delivered strong operating leverage in FY25 or FY26 does not automatically mean the stock will outperform in FY27. The market constantly tries to discount future expectation in advance. That's why, while analyzing operating leverage stories, you need to study investor presentation and management con calls. So majority of companies conduct con call post-quarter result where they answer analyst questions. In these con calls, you get a better understanding around your demand outlook, like how is industry demand looking, is demand improving, slowing down or remaining weak. Then growth drivers, like what will drive growth going forward. New products, capacity expansion, export, premiumization, market share gain, new customers, and so on. Then market outlook. Can margins improve further? What factors can support or hurt profitability? Like it includes raw material price, operating leverage, utilization, pricing power, cost optimization, and so on. Then capacity expansion and capex detail. Is the company adding new plants or capacities? When will utilization improve? How much growth can this unlock? Then how is the industry tailwind and risk? So management often talks about industry opportunities as well as challenges like competition, pricing pressure, regulation, slowdown, oversupply, and so on. And of course, future guidance. So some companies provide revenue growth, margin, volume, capex guidance for future quarters as well. So reading the investor presentation and con call help you take an informed decision. Of course, it's quite boring and you need to spend a lot of time. Now the challenge is for retail investors with a job or business, I'm sure it becomes extremely difficult to track so many things. And that's where I try to add value with my exclusive weekly video that you can find on my join button of this YouTube channel where I deep dive into macro events, key trends, and I also track nearly 200 companies including their quarter result. So that really helps in generating a lot of insight and taking an informed investment decision. The same weekly video are also available on my website. In case you want to explore it, I'll provide the link in the pinned comment. Then another very important aspect is you need to assess how much of the good news is already priced into the stock. Now this is extremely important. Sometimes a company may continue to deliver strong earning growth, but the stock may still remain flat or it may even underperform because valuations have already become too expensive as the market has already discounted the future good news. In fact, this is the biggest problem with Indian market today. Since the domestic inflow of money is so strong, the companies that are growing at fast rate and where earning growth are strong, they already command a premium valuation. So that becomes very tricky. We'll discuss it further with example. And another very important point, sometimes you may also see stocks falling sharply when management give high growth guidance and company fail to deliver due to various reasons. So at the end of the day, investing is a game of probability, not certainty. You can't be certain that all your bets would work out. That's not possible. I mean, until a few quarters ago, who thought that IT companies would be the biggest loser today? Mind you, just a few years ago during COVID, IT was one of the biggest wealth creator. So there will be uncertainties, factors that are not in our control, but as long as you have a right framework for stock selection, you do well at overall portfolio level. So with that framework in mind, let us now discuss companies where operating leverage can potentially continue in FY27 and what exactly could drive that profit expansion further. So first company where management has guided for margin expansion in FY27 is Laurus Labs. Now if you're following this channel, I've been tracking Laurus Labs for a very long time now. It's been a roller coaster journey. Its margin expanded significantly from 16% to 32% during COVID. That resulted in exponential profit growth. Stock also went through re-rating phase that resulted in exponential growth in share price. Then there was a phase when company's margin contracted from 32% to 29%, then 26% and then 15%. And its profits tanked badly. As a result, its stock price tanked badly. A lot of people started calling it bogus lab. But I remember doing two videos, one in February 23, another in February 24, where I clearly explained the reason for underperformance. The first biggest reason was Laurus Labs invested significantly in capacity building, where it invested around 2,500 crore to build API and CDMO capacity. And obviously that investment takes time to materialize. However, in FY26, company has finally entered the monetization phase of the massive capex it did during that period. Then another reason was product mix. Earlier, Laurus was heavily dependent on ARV API, where pricing pressure was intense. But now the portfolio has become more diversified with higher value APIs, oncology product, etc. As a result, company's margins have jumped from 15% to 26%. And hence, its profits have again exploded. In fact, in latest quarter, Laurus Labs has reported margin of 28%. Interestingly, in latest con call, there was question on how sustainable are 29% EBITDA margin. And management said, we are very comfortable with maintaining or improving EBITDA margin in FY27. The question is, what are the drivers behind operating leverage? So one of the biggest reasons management is confident about further margin expansion is because Laurus is gradually shifting away its dependence on low margin commodity style ARV API towards higher value businesses like CDMO, oncology APIs, complex chemistry, peptides, and biotech related manufacturing. These segments usually have better pricing power, lower competition, and stronger customer stickiness. Second reason is CDMO projects are now moving from development stage to commercial manufacturing stage. In the early phase of CDMO project, margins are usually lower because the company spend heavily on R&D, validation, regulatory work, process optimization, and smaller batch production. But once the molecule reaches commercial scale, economics improve significantly. In fact, 6 years ago, CDMO was just 13% of company's revenue, and today it is 30%. Management has guided that they intend to take it to 50% by 2030. Then third reason for margin expansion is due to operating leverage. Over the last few years, Laurus has invested heavily in manufacturing blocks, biotech infra, fermentation capability, R&D facilities, and specialized chemistry capacities. Most of these costs are fixed in nature. The infrastructure has already been created, but utilization is still rising. So incremental revenue in FY27 may come without a proportional increase in fixed expense. In simple word, the company has already built the engine, now it is trying to run the engine at higher capacity. Hence, Laurus should continue to do well in FY27. But the big question is, how much of the good news is already priced into the valuation? So from valuation point of view, at a price to sale of 10, EV to EBITDA of 40, price to earning of 80, Laurus is not cheap by any standard. Sure, with margin expansion and profit rising sharply, PE would fall. But still, considering that, valuation comfort is less. At current valuation, market is expecting flawless execution. But here, you need to understand one thing. CDMO is inherently a lumpy business. CDMO earnings often look extremely strong when your commercial molecules scale up, plant utilization rises, and operating leverage kicks in simultaneously. But the reverse is also true. If one large molecule slows down, if innovator timelines get delayed, revenues can suddenly become volatile for a few quarters. So the best time to accumulate CDMO stock is during the slowdown phase when the market is pessimistic and stock is down. Of course, it requires a lot of conviction to buy when sentiments are negative. Second company where management has guided for margin expansion is Radico Khaitan. If there's one company that has been one of the strongest beneficiary of premiumization and consumption theme in last few years, it has to be Radico Khaitan. Just look at the margins. Consistently jump from 11% all the way to 17%. While its revenue has grown 2 times in 3 years, due to margin expansion, its profits have jumped nearly 3 times. In latest Q4 result commentary, management clearly mentioned that we are confident of sustaining our margin expansion trajectory in the coming year. Specifically, management guided for 20% volume growth in prestige and above portfolio and overall 125 basis point increase in overall margin in FY27. Now, what is the reason? So as discussed in first part, earlier a large part of Radico business was dependent on regular and semi-premium brands where margins were relatively lower. But over time, the company aggressively scaled up its premium portfolio through brands like Magic Moment, Royal Ranthambore, Rampur and Jaisalmer. Premium liquor carries significantly better gross margin because pricing power is higher and competitive intensity is lower. As the share of premium product increased, overall profitability improved structurally. This slide gives a good picture of how prestige and above brand contribution in overall volume has increased from 29% to now at 45% in last 6 years. Not only that, even the realization, that is price per case, has consistently increased for prestige and above category. Management is also confident about future margin expansion because they believe the premiumization journey is still in early stages. Prestige and above category is growing much faster than the mass segment, and company want premium brands to become a much larger part of the portfolio over the next few years. So as the premium contribution rises further, blended margin can continue to improve. Another reason for confidence is that the newer luxury brands are now scaling up after initial investment years. In alcohol business, brand building expenses are higher initially, but once the brand gains acceptance, profitability improves sharply because pricing power strengthens while marketing costs become more efficient relative to scale. Management also expects margin improvement from better operating efficiency, backward integration, and improving scale in international business. Please note that the export opportunity for premium Indian spirit are increasing globally, especially for brands like Rampur and Jaisalmer, which can further support the margin expansion because premium export usually carries superior profitability as compared to your regular domestic product. So all these factors should result in further margin expansion for Radico Khaitan and higher profitability. On valuation front, the valuations are certainly not cheap. But like I said earlier, the catch is even after a good period of correction and consolidation in Indian market, the high growth companies still command a premium valuation. So Radico Khaitan is certainly not a value buy, but it is definitely a strong play on Indian premiumization theme with solid growth opportunity. Now you need to decide if it is worth buying at current levels or not. Third company where management has guided for solid margin expansion is MTAR Technologies. So if you look at company's margin profile, it tanked badly from 34% in 21 to 18%. However, in 26, margins have recovered to 20%. Interestingly, in FY26, its revenue has jumped around 30% and due to margin expansion, profits exploded by 75%. Now, if you're following this channel, I used to track MTAR very closely and discussed it multiple times on my channel. In fact, I even added this company in my portfolio and explained the reason. However, in 2024, I did a video titled Biggest Learning from My Mistake. So basically, when I added MTAR, the thesis was simple. MTAR was a play on clean energy, especially your electrolyzer and fuel cell related opportunity. Company was also growing at a fast rate. However, then situation turned. Company's profit tanked badly and promoters kept on selling stake. And the worst part was, management kept on over-promising and under-delivering. It went on nearly 3-4 quarters and then I eventually lost trust on management. However, in 2026, MTAR has recovered strongly. But the crazy part is FY27 guidance. In latest con call, management has guided for 80% revenue growth in FY27 and margin expanding to 24%. Just to give you an idea, if management can achieve these numbers, MTAR FY27 profits can be around 300 crore. That would be 3 times our FY27 number. No wonder market has already factored in the growth and stock has already jumped exponentially. Now there are 2 questions. What factors resulted in management giving 80% revenue growth and 24% margin guidance for FY27? So for last few years, company had built capabilities across clean energy, civil nuclear, aerospace, defense, fuel cell and export-oriented precision engineering. But many of these opportunities were either in qualification stage, low volume stage or delayed due to customer timeline. Now management believes several of these programs are finally entering large-scale execution phase together. MTAR expects to nearly double its closing order book from 2,580 crore at the end of FY26 to approximately 5,000 crore by end of FY27. Company holds its strongest ever nuclear order book of over 650 crore, which is expected to see a significant revenue upsurge in current year as execution accelerate. Then a significant new growth vertical has emerged with a long-term contract for AI data center infra. that has a potential for revenue to reach 400 to 500 crores over the next 2 years. On margin, management expects at least 5% operating leverage benefit as higher turnover allows them to better absorb fixed costs like your salary, existing infra expense and so on. Many sectors, particularly aerospace and defense, are moving from costly first article, that is prototype phase, into steady volume production, which inherently carries better margin. However, you also need to understand the risk side carefully. Businesses like clean energy, hydrogen, aerospace, defense can look extremely strong during execution upcycle, but they are also vulnerable to delays in customer program, policy changes, funding cycle, and project postponement. So the key question is not whether FY27 growth can happen. It probably can if execution remains smooth. The bigger question is whether this growth becomes sustainable over multiple years or whether FY27 turns out to be an unusually strong peak year. And of course, how much of the good news is already priced in? Well, today the valuations are absolutely crazy. But then growth guidance for FY27 is also crazy. So stock can remain in momentum as long as company is able to deliver what it promised. Now in the last video, we also covered a lot more companies like Mahindra & Mahindra, TVS Motor, Ether Energy from auto sector, then Acutaas Chemical, BSC, MCX that have reported solid operating leverage. But the question is, can they continue to show operating leverage in FY27 as well? So if you attend any latest con call from auto sector, one thing that is common among all is there's a significant margin pressure. It's because commodity costs have started rising again due to geopolitical tensions and supply disruption. Steel, metal, plastic, synthetic rubber, freight, and energy-related costs are increasing, which directly impact auto OEMs' margin. Many companies have already started taking price hike, but passing on cost fully is difficult, especially in price-sensitive segment. Then another concern is, due to significant high crude oil prices, there's a risk of sharp increase in inflation. Higher crude prices increase transportation, logistic, manufacturing costs across economy. This pushes up overall inflation and can reduce disposable income. When household budget come under pressure, demand for auto, particularly mass market vehicle, tend to reduce first. So in the near term, margins for auto sector can remain under pressure. But having said this, the long-term growth potential is very strong for auto companies like TVS Motor, Mahindra & Mahindra, Ether Energy, and for that matter, auto ancillary company like Precall, Sansera Engineering, Craftsman Automation, Sona BLW, and so on. Next, if you look at Acutaas Chemical, its margins have expanded significantly in FY27 and FY26. For FY27, management has guided for 25% growth in top line. However, on margin, management said that there are near-term cost pressure due to supply chain disruption. However, they are confident to maintain EBITDA margin at similar level in FY27. So Acutaas may not see further margin expansion in FY27, but still margins would sustain. And the good part is growth would continue to be there. Acutaas has 3 growth engines: pharma intermediate, semiconductor, and battery chemical. Out of 3, so far pharma segment has fired, and semiconductor and battery chemical engine are still in early stage but have all the potential to fire in near future. Another company that has posted exceptional number in Q4 and margins have expanded significantly is TD Power. Company has revised its revenue guidance for FY27 to 2,400 plus crore. That translates to around 30% growth in FY27 as compared to FY26. And interestingly, management indicated that there's an extremely high probability that this guidance will be increased further to match the strong rate of order inflow seen in Q4 and expected throughout the upcoming financial year. The biggest driver for TD Power is data center. These facilities require massive uninterrupted power. If you recall, we have discussed this in detail when we covered the data center stocks and the entire value chain. So this has created immediate need for on-site captive power generation and backup power, which directly drives demand for TD Power's specialized generator. The second leg is the global energy transition. Renewables like wind and solar are intermittent, so grid needs stabilization support. Hydro, geothermal, waste to energy, and gas balancing system. This creates constant demands for generators. And this is not a one-year spike. This is a system-level change in how electricity grids are built. That is why order inflows in export markets have structurally improved. In fact, management said that the demand is so high that customers are monitoring deliveries on a weekly basis, taking machines as soon as they are ready. Now, as far as valuations are concerned, TD Power valuations are touching the roof. This is clearly not a value buy as market has already sensed high growth in the company. Having said this, considering the crazy demand company is witnessing, TD Power can be an interesting momentum bet. However, in momentum stocks, exit is also equally important. And finally, if you look at metal sector, many companies today are going through margin expansion phase. However, metal is highly commoditized cyclical sector where margins can jump significantly during good times and can also fall significantly during bad time. And that makes metal stocks extremely volatile. So the key takeaway from this entire discussion is that markets are currently rewarding visibility of growth and margin expansion more than anything else. Whenever companies show improving utilization, better product mix, or strong order inflow, margins expand quickly because fixed cost absorption kicks in. But the same operating leverage can reverse just as fast if demand slows or execution gets delayed. This is why identifying whether the operating leverage is structural or cyclical becomes extremely important for investors. At the same time, the broader macro environment is not very supportive. India is currently dealing with high crude oil prices, INR depreciation pressure, and global geopolitical uncertainty. These factors impact inflation, input cost, interest rate, and overall consumer sentiment. In such an environment, it becomes difficult for most sectors to sustain the broad-based margin expansion. Many industries like auto, chemical, and industrial can remain under pressure in near term due to cost inflation and weaker discretionary demand. However, despite this macro headwind, the market is not moving uniformly. We are clearly seeing strong pockets of demand in specific themes and companies. For example, premiumization in consumption like Radico Khaitan, then global export-led manufacturing like TD Power, and specialized engineering or CDMO-led platform like Laurus Labs, MTAR Technologies are still witnessing strong growth cycle. These are not broad economic story. They are company-specific or theme-specific demand cycle that are currently driving out performance. Well, let's close the discussion here. Now you tell me in the comment which business you find most interesting from this list. And also if you find this video useful, do share it within your circle. And if you want me to deep dive into a specific company, let me know in the comments. I'll see you in the next video. Till then, take care.